I'm Abolore. On today's episode, we'll be looking at manufacturing accounts. So, uh, we're going to be looking at the definition, the some terminologies which you need to understand regarding manufacturing accounts, and we are going to be drawing the formats. And peradventure, we're going to be looking at questions. So, let's begin with the definition, the meaning of manufacturing accounts. So when a business organization is into production of goods, then such firm will have to prepare manufacturing accounts primarily to determine the cost of production of that particular product or commodity. So manufacturing account is prepared to determine the cost of production, and that's why most times manufacturing account is also called production account. So another word for manufacturing account is production account. So now that we've said that manufacturing account is to determine the cost of production, so basically in order to determine the cost of production, you will have to add some costs together. So, in order for you to determine the cost of producing the goods or commodity in question, so that's with respect to the meaning of manufacturing account. It is prepared to determine the cost of production of goods that the company is into its production. So let's talk about some terminologies, some words that are peculiar to manufacturing accounts as a statement. So terminologies, terminologies, terminologies used in manufacturing accounts, used in manufacturing accounts. So we're going to be looking at element of costs, elements, element of costs. Then we are going to look at prime costs. We're going to look at prime costs. Then we're going to look at overheads. Overheads. We're also going to look at uh, work in progress. The meaning of all these words, you need to understand them because most times students may be asked to write short notes on some of this. So by the time we're breaking it down here, you'll be able to at least write perhaps a page on any of these when you are asked. So work in progress, we're going to be looking at uh, the conversion costs. We're also going to look at conversion costs, and we might be looking at the market value. The market value. Perhaps you're given market value in most questions. So we're also going to look at these as well. Then let's begin with element of cost, or let's say cost, basically. Let's say cost. You can say cost also. So another word for costs is expenses. And expenses are those amounts a firm incurs in the production of goods that such is into its production. So when we say costs, you have to spend costs on some items if you want to produce any particular commodity. So that will lead us to talking about elements of cost. So elements of cost are those items on which costs are incurred. So basically there are three elements of cost. So element of cost now. Elements of costs. So the elements of cost are basically three. We have material, we have material, and we have labor, and at the same time, expenses. So The first element of cost is material, then labor and expenses. So these are the items on which a firm will have to spend money on if the firm is into production of goods that such a firm is into its production. So material, labor, and expenses. So when we say cost, cost can either be direct or indirect. So when we say a cost is direct, a cost is said to be direct when such can be traceable to the production of a particular commodity. So when we say a cost is direct, that means we can have direct material costs, we can have direct labor costs, and direct expenses. So I hope that is understood. So direct costs are costs that can be traceable to the production of a particular commodity. Then we are going to break that down where we talk about this in detail. Then on the other hand, costs can also be indirect. So indirect costs, on the other hand, are costs that are most times incidental or that cannot be traceable to the production of a particular commodity, that's goods or services basically. So indirect cost also can be spent or can be incurred on, so you can have indirect material costs, you can have indirect labor costs, and indirect expenses. So that means, in a nutshell, the total cost of material that is incurred or that is spent money on in producing a goods or services can either be direct or indirect. So material, the cost of material can either be direct material costs plus indirect material costs. Can you see now? So the total cost of material can either be direct or indirect. The same thing, labor costs. Labor costs can either be direct labor costs, direct labor costs, and also indirect labor costs. And expenses as well can either be direct expenses, and indirect expenses. So what do we mean by, let me just shed light on. So this is what we mean. Okay, I'll come back to explaining some of this. So when you had direct material cost, direct labor cost, and direct expenses, you are going to be having prime costs. Prime cost. That's what you have. So prime cost is the addition of all direct costs. And examples of all direct costs are direct material costs, direct labor costs, and direct expenses. So when you add all the direct costs, you will have prime costs. Then the addition of all indirect costs, that's indirect material costs, indirect labor costs, and indirect expenses. The addition, the summation of all indirect costs will give you overheads. So overheads is the addition of all indirect costs. So this is what you have. Then when you add your prime costs with your overheads, you are going to have production costs. Production costs. Or most times you can call it factory, you can call it factory overheads. Factory cost of production. Factory cost of production is the same thing as production costs. So it's the same. So you can see how we arrive at the production cost or factory cost of production. It's by adding the prime cost plus overheads. And don't forget, we did say prime cost is the addition of all direct costs. That's direct material, direct labor, and direct expenses. Then overheads is the addition of all indirect costs. That's indirect material costs, indirect labor costs, and indirect expenses. So when we say direct material costs, they are those costs. Don't forget, I did say that direct costs are those costs that are traceable. So direct material, material is what you can see and touch basically. And let's say, for example, our firm, our business is into production of this marker. This marker now, the direct material cost on this marker are the purchase of this cover. You can see it on the products. You can trace it. This, all these you have on the products, they are material. You can see them, right? So all the costs incurred on them is direct material costs. So all the material you can see on the products, the cost incurred on them are called direct material costs. Then indirect material costs. Let's say, for example, this marker that we have produced and we want to sell it to our customers. While selling it, we are going to issue receipts. Let's say we sold 2,000 or 2 million units of this marker to our customers. We will want to issue them a receipt. And that receipt is material. That receipt, the cost of producing it is also going to be added to the cost of production. So in that regard, the cost of producing that uh, receipt, receipt is a material, but that receipt cannot be found on this marker which we produce. So the cost of producing that material receipt, which is material, is called indirect material costs. So it's as simple as that. So any material that cannot be traceable to the production of that particular commodity a business produces, then such cost is regarded as indirect material cost. That's that. Then direct labor costs. Direct labor costs are those costs of production that are also traceable to the production of a particular commodity. So, but the labor we are referring to here are those labor that's the cost of this labor here, that's direct labor costs. They are those costs on labor that are directly traceable, that are directly attributable. Those labor that are working on the factory floor, those ones are the ones that are actually working to produce this marker we are producing, because this marker is produced in the factory, not in the office. So the cost incurred on those labor that are working on the factory floor, the cost on them is known as direct labor costs. And indirect labor costs, the costs on labor that are not traceable to the production of a particular commodity. So let's say, for example, the costs incurred on staff that are not working in the factory. So those ones are working in the office. So the costs incurred on, let's say, accountant salary, uh, the lawyers of the company, all those ones are not labor that are working in the factory. So those ones, the costs incurred on such labor are called indirect labor costs. So I hope that is understood. So this labor here, they are not having direct relationship, or they are not working on the factory floor of the company, or they are not working directly towards the production of the commodity the company produces. So the cost on those labor, like I said, the accountants, hey, is indirect labor costs. And the last but not least, direct expenses. Direct expenses are those expenses that are directly attributable to the production of the commodity in question. That's, let's say, this marker now. So for example, and don't forget these expenses, they are incurred on the factory floor. But these ones, they are not incurred on the factory floor. So these ones now, they are incurred on the factory floor. Like let's say, for example, uh, manufacturing wages. Manufacturing wages. We can have royalty. and so on and so forth. So those are examples of direct expenses that are attributable to the production of a particular commodity. But these, they are not. They are incurred perhaps outside the factory floor of the business organization. So examples of indirect costs. You can have uh, cost of, let's say, costs that are not incurred basically on the factory floor are regarded as indirect expenses. So let's say, for example, we can have carriage outwards. Carriage outward is not uh, traceable or is not incurred on the factory floor. It's outside, maybe cost of advertisements, eh, like that. So all those are indirect expenses. So I hope this is understood. So when you add all this, you're going to have overheads, all the addition of all the indirect expenses or costs. You're going to have overheads. Addition of all the direct costs. You are going to have prime costs. So that's what we have. So we have indirectly talked about element of cost, prime cost, and overheads. So then let's look at prime cost uh, in maybe let's shed light on that prime cost more. So I hope this is understood. So so prime cost. So prime costs. So prime cost, like we said, is the summation, is the addition of all direct costs. That's addition of direct material, direct labor, and direct expenses. Now, most times in preparing the manufacturing account to determine prime costs, it's very simple. So prime cost can be determined in two ways, basically. So the first which you have, that's prime cost equals direct material costs plus direct labor costs plus direct expenses. This will give you prime cost. Or you can have prime costs to be prime costs, sorry. You can have prime costs to be cost of cost of raw materials consumed, cost of raw materials consumed plus direct direct costs. So when you have cost of raw material consumed, then you add the direct cost to it, then that will give you prime cost. So examples of direct costs you could have you could have manufacturing wages. So manufacturing wages is an example of prime direct costs. You could have royalty. Royalty is also a direct cost. And all other direct costs which you could have and all other direct costs. So when you add all this to cost of raw material consumed, that's going to give you prime cost. So that's basically what you have with respect to prime cost. So let's go to the other one. So we have so overheads. Overheads, like we said, is the addition of all indirect costs. So indirect material costs, indirect labor costs, and indirect expenses. So examples of overheads, because most times we call it factory overheads. We can have factory insurance, we can have fuel and power. So any cost basically that is incurred, most times uh, expenses of running the factory, let's put it that way, that's factory overheads. Costs that are attributable to running the factory as a department, then we tag them as overheads. And they are indirect costs. Don't forget, they are incidental to the production of a particular commodity. So that's with respect to that. So addition of all indirect costs makes up overheads. Then let's talk about work in progress. So work in progress now. work in progress. So work in progress basically from the word work in progress. Work in progress are basically partly produced goods whose production process has not been completed. So they are basically regarded as unfinished products or goods whose production has not been completed. So work in progress, that's just what it means. Partly produced or partly finished goods or goods that its production has not been completed. So when a goods has not been, the production of a particular goods has not been completed, such goods will be regarded as work in progress. So most times in a manufacturing concern, they will always have work in progress at the end of the period. That means at the end of the accounting period, which is usually 12 months. They will always have that. And when they have that at the end of the period, they will carry it forward for the next period. That's for the next accounting period. So every manufacturing concern will always have work in progress. And for example, let's say a road construction is ongoing. The company may not finish the construction of that road. So that road is that has not been finished, that its production, its construction has not been completed. It's called work in progress for the end of the period. Then it will be carried forward for the next period. Then for the next period, at the end of the next period also, you will have closing. Then it will also be carried forward. So for every manufacturing concern, they will always have work in progress at opening, which is for the last year, which will be closing stock for the last year. Then it will be opening stock for this new period. So they will always have every manufacturing concern. They will always have opening stock, work in progress, and closing stock of work in progress. So this work in progress can be opening, work in progress, opening work in progress, and closing work in progress. So opening work in progress will be added. Opening work in progress will be added to the gross cost of production. Gross cost of production, gross cost of production. And this closing work in progress will be deducted from the gross cost of production. So this opening work in progress, we add it to this. And the closing work in progress, you are going to less it. After you have added this, whatever you get, you are going to less this from that. That's the closing work in progress. That's with respect to a work in progress. So work in progress, like I said, are partly produced goods whose production has not been completed or they are not finished yet. That's what that means. Then let's go to conversion cost. So this is gone. So conversion cost now. So conversion cost from the word conversion, conversion costs. Conversion costs are costs that are incurred to transform or to bring direct material to be a finished or semi-finished goods. That means conversion costs are costs that you spend on direct material to bring it into semi-finished goods or finished goods. So let's say, for example, a business organization, a manufacturing concern here, because it has to do with any business that is into manufacturing of goods or services. You don't manufacture goods or services, you render services, but we are referring to any company or any business organization that produces goods. So a manufacturing concern already has direct material. They already have material. Then they want to convert this material to finished finished good or finished products. So the cost they are going to incur, the cost they are going to spend to make this direct material to become finished or semi-finished goods is conversion costs. conversion cost. So to get your conversion cost now, it's very simple because you already have direct material. Then you want to make this, you want to transform this into finished goods. So this is two ways now you can get your conversion cost. You could have, if you have, for example, factory cost of production, factory cost of production, factory cost of production minus direct material cost, direct material cost. Then you are going to have your conversion cost. So let's say the total cost of production is 100 and the material, the direct material we have, let's say that is 20. So 100 minus 20, that gives you 80. So 80 naira is the conversion cost. That means the cost of bringing the direct material or converting or transforming the direct material to finished goods is 80 naira. Another way you can get your conversion cost, look at this. Don't forget that prime cost is the addition of all direct costs. So you already have direct costs. You already have direct material costs. Don't forget prime cost. Okay, let me put it this way. Let's say prime cost plus factory overheads, factory overheads. That gives us the total cost of production. So in this prime cost, you already know that you have your direct material, direct labor, and direct expenses. You have all those three costs to make up prime cost. And you also have three costs here that makes up factory overheads. That's indirect material costs, indirect labor costs, and indirect expenses. So what we have business with is this, which is prime cost. So here now, if you have this prime cost split into three, you will have direct material, which we already have, which is the material we already have. So since you already have this, then you will add direct labor costs and direct expenses. So we already have this direct material. So you are going to add to this direct material direct labor costs, direct expenses, plus factory overheads. So the addition of direct material costs, direct labor costs, and factory overheads will give you conversion costs. So I hope that is understood now. Let me take that again. We already have direct material. We already have material in our manufacturing concern. All that we need to do is we want to convert this direct material to finished goods. So what are we going to add? What are the costs we are going to add to that direct material to make it a finished product? Then we are going to add direct labor costs, direct expenses, and factory overheads. And don't forget, factory overhead comprises indirect material costs, indirect labor costs, and indirect expenses. So it's more of the same thing we have here. So factory cost of production is the addition of prime cost plus overheads, factory overheads. So this cost of production, which includes direct material cost. So when you minus direct material cost from factory overheads, that's factory cost of production, then what you are going to have left is factory overheads plus not the whole of prime cost, but direct labor costs and direct expenses. That's what you have basically. So that's that. So to get your conversion cost, you can either use this or this. So to get your conversion cost, you have factory cost of production minus direct material cost. You're going to have this. Or you had your direct labor cost. This is not inclusive. Direct material cost is not inclusive because you already have material. Then so you have direct labor cost plus direct expenses plus factory overheads. So this is with respect to conversion cost. Then let's talk about the last one, which is market value. So market value now. Market value So we're almost uh, done with the terminologies. So the last one is the market value. So market value. So for market value, another word for market value is the selling price. The selling price. That's the price at which the products we are producing in our company is sold in the markets. That's the market price, market value or selling price. Now, for a manufacturing concern, it is advisable at times to know the cost of the market value and the cost of production of the products you are producing. So if we are into production of marker, for example, we have to know the market value of this marker first. Then we will compare it with our cost of production in our factory. So this is what we are saying here. If the market value of this marker in the market, we want to start producing this marker, assumption. This marker is already in the market. So we also want to join the league of producers to be producing this marker. So we have to determine the market value of it. That's the selling price. So let's say the selling price is 100 naira. Look at this. Or the selling price is 100 naira. Then look at this now. If, for example, we now produce this marker in a business organization, we produce it at, let's say, 80 naira. So with this now, we can go into production of this marker because the cost of production, this cost of production is less than the market value. So if you produce it at 18 naira, all the cost of production, total cost of production in our factory is 18 naira. Then we can decide to add our profit element of, let's say, maybe 20 naira, depending. But if we want to beat our competition, we may add 15 naira as our profit. Then our own market value will now be 95 naira. So we'll be able to beat our competitor. So with this now, it is advisable that we produce this marker in our own factory because our cost of production is lower than the market value. And also, when we had our profit element, it's still lower because we'll still be able to beat our competitor. So it's advisable to produce in our own factory now. Here. But on the other hand, so here now, okay, on the other hand, if the market value is still 100 naira, that's the selling price in the market of this marker, and we want to start the production of this marker. Then after everything, we've produced it. We realize that, or after we've cost everything, all the prime cost, factory wise, and all that, after we've cost it, we realize that the cost of production is 110 naira. Look at this, cost of production is 110 naira. What this means is that it is not profitable for us to go into production of this marker because our cost of production is higher than the market value. And what this means is that we'll be making loss when we decide to go into production of this marker. That's what it means. So here now, it's not advisable for us to go into production of this marker. Rather, it should be advisable for us to go and buy from this company and resell. We will buy at 100 naira. That's the cost of production, market value. We buy. Then we sell at maybe 105 naira. So here now, here, it is advisable to go and buy rather than producing. You buy and sell rather than producing in your factory on your company because you'll be making a loss here. But here, it is advisable that we produce this product or we start the production of this product. We will still sell and make a profit. Then we'll be able to beat our competitor here. So it's advisable to produce in the factory here. But here, it's not advisable to produce in the factory. But it's advisable that we go to buy from this company whose cost of production uh, is perhaps lesser, and then we buy from them, we'll be able to sell perhaps at 105 and still beat them and say bits by okay, okay, yeah, we can buy from this company at 100 naira, then sell at 105. That means we've added our profit margin, which is 5 naira to it. So that's what it means. So it's not advisable we produce it. So most times when you are given market value or selling price of the products in a question, you will be asked to determine the profit element regarding what you have produced in your company. So this is basically what we have regarding that. So with respect to market value now, after after you have determined the cost of production in your organization, let's say the cost of production in your organization is, let's say, 200 naira, and you are given in the additional information, mostly in additional information, you'll be given that so goods should be transferred to the trading account. They may give you 300 naira. That means so goods should be transferred to the trading account, 300 naira. Or they may say the market value, market value is 300. So what this means is that you'll be able to determine the profit here. So that means since the market value is 300, or the goods to be transferred to the trading profit and loss account is 300, then you will have the profit element. So you have profit elements. Now, with respect to the manufacturing account, you have the market value here, the market value. So market value is 300. This is what you have. Then you have, so to get your profit elements now, profit is, don't forget, profit is selling price minus cost price. That's your profit. Or market price minus cost price. That's cost price is the same thing as cost of production. Selling price is the same thing as market value. So your selling price there is 300 minus your cost price, which is cost of production, is 200. So 300 minus 200, that gives you 100 naira. So that's how we get our profit. So our profit is 100. So this is profit element on manufacturing. Manufacturing. So what this means is that it is profitable to produce the goods in-house or in our company. So in your trading profit and loss account, this market value will represent your purchases. This will represent your purchase. Ordinarily, if you had not been asked to determine the profit element and you are not given the market value in the question, that means you will not determine this. You will not determine this too. So this is what we transfer to the trading account as your purchases. That's cost of production. But if you are given market value, or so amount should be transferred to in the additional information. So it depends whether you are making profit or loss. Do you understand? Even though you are making profits or you are making loss, you will still transfer this to the trading account as your purchases. So this will represent your purchases in the trading account. That's uh, purchases of finished goods. This will represent it, 300 naira. Not this, not this. But if you are not given this, you are not given market value, then this will represent your purchases in the trading account. That's purchases of finished goods. We are going to draw the format and you'll be able to understand all this that we are talking about. So this is with respect to market value. Or most times when you are given in the additional information that so amount should be transferred to the trading account. So that wraps up the terminologies regarding manufacturing accounts. Then let's prepare the formats now so that you'll be able to have a noting acquaintance of how manufacturing account is prepared. Then after which we solve a question. So let's do the formats together. So, so let me start here. So manufacturing account. So let's say the name of the business is uh, Dangote. So let's say we have Dangote PLC. So we have manufacturing, manufacturing, trading, trading profits or loss account for the year ended 31st December, let's say 2020. So this is what you have. So let's start with, so here we have, so like I said, with respect to manufacturing account, we are going to be looking at cost, just cost, because we want to determine the cost of production. That's basically what we have. So we have opening stock. So we have opening stock of raw materials, opening stock of raw materials, opening stock of raw materials. This is what we have. So we put that here. Now, second column. Then we have purchases, purchases of raw materials, purchases of raw materials. So we put that in the first column. Then we had carriage on raw materials, carriage on raw materials. We add it to our purchases. Then we less return on raw materials, return on raw materials. We less that. Although we've put less here, we also put it in bracket. Most times you may not put less here and you put it in brackets. So whichever, I'll just do one of the two. But most times when you do the two, there is not usually a penalty for that. So this purchases plus carriage inwards minus return out of, then you're going to be having net purchases. That is called net purchases of raw materials. Then this net purchases will be added to your opening stock. Then you have costs, cost of raw materials, cost of raw materials available for use. Then we less closing stock of raw materials. Then when you less this from this, we call this costs of raw materials, cost of raw materials consumed. Cost of raw materials consumed. Then we add to this cost of raw material consumed direct costs. So like we said now, because we want to get our prime cost now. So to get our prime cost, we are going to add to cost of raw material consumed all direct costs. So examples of direct costs. So you can have direct costs, direct costs. Examples of direct costs, you can have manufacturing wages, manufacturing wages. This can also be called factory wages, factory wages. So any of the two you are given is the same. So factory wages, manufacturing wages, they are the same thing. Then we can also add royalty. Royalty is also a direct cost. Royalties, can add it. And all other direct costs, you add it. Then when you add your cost of raw material consumed plus all the direct costs, you're going to have prime costs. So prime costs. So prime cost is what we have. And don't forget, prime cost could also be gotten by adding all the direct costs. That's direct material, direct labor costs, and direct expenses. Then we have to this prime cost. We want to get our cost of production now, or factory cost of production. So we're going to add factory overheads. So factory overheads. So we have, for example, examples of factory overheads cost now. So we have factory insurance, factory insurance. So we have that here. So we can have factory rents, factory rents and rates, factory rents and rates. We can have fuel and power, fuel and power. We could have uh, supervisors, supervisors' wages. Most times, supervisors' wages is an indirect cost. So you can have it. Okay. Then you can have lubricants. Lubricants. That's oiling your machine and all that. They also incur in the factory. So you could have repairs, repairs of plants, plants and machinery. Repairs of plants and machinery, you can have it. So let me continue from here. So we have our two naira sign. So we could also have depreciation. That's still under factory overhead. So we could have depreciation on plants and machinery. Why are we having depreciation on plants and machinery? Because it is used in the factory. Are we together? So any item or any assets that is used in the factory, any depreciation on it will be uh, will be recorded or will be stated under factory overheads. So this is what we have. Then we could have factory insurance. Okay, we've gotten that factory insurance. So any other factory related items, we can bring it here, except factory wages. I hope that is taken. So, so basically, this is what we have for factory overheads. Then we had everything. We had this. So adding it, we have, let's say, we have this as total. After we've added all this plus this, then we have this. And this that we have now, we add it to the prime cost. This is the prime cost. Then when we add it, we have gross gross cost of production. Gross cost of production. Then we have this. So let's say our prime cost is, let's say, 100. Then our factory overheads total after adding all this and this, the total, let's say, is 150. So 150 plus 100, that gives us 250. So this is what we have. Then I haven't gotten this gross cost of production. This should have been our cost of production, but because in a manufacturing concern, we always have work in progress. So like we did say that we had opening, work in progress, work in progress. We add it to the gross, then whatever we have this. Then we'll now less closing work in progress. We'll less it. So we less this. So this is what we call factory costs of production, or we can simply say production costs. It's the same thing. Production costs. So when you are now given the market value or in the additional information, so amount should be transferred to the trading account. The same thing as the market value. So that market value, you're going to have your You leave a line, you draw a line, then that market value you are given in the question, you are going to bring it. This is the market value, which I said is the same thing as the selling price. Okay. So then market value minus the cost of production will give you the profit element. So profit element of manufacturing basically. So for you to have had profit element here, it means your market value is greater than your cost of production. And you could also have loss. That means when the market value is lesser than the cost of production. So this profit element will be taken to the profit and loss account to be added to your gross profits. So this is where manufacturing account stops to determine the cost of production or the market value. That's the selling price. So this market value, like I said, will be transferred to the trading profit and loss account. That's the trading account. It will represent your purchases. So most times you will not always be given purchases figure. You will use this as your purchases. So I hope that is understood. We are going to solve a question to illustrate everything. So let's say this is work in progress is 1, is 5. So 250 minus 5, that's 245. And let's say this is, okay, sorry, this is added, let's say 50. You had the opening work in progress. So 50 plus is that's 300. Then 300, let's say this is 30. 300 minus 30, that's 270. Then 270 now, let's say this one is 400. So 400 minus 270, that's 130. So our profit is 130. So 270 plus 130, that will give you 400. I'm just trying to denote it so that you know how everything works. So this is where manufacturing account stops. So let's continue with the trading uh, profit and loss account because it's manufacturing trading profit or loss accounts. So then we just start with our sales, or you can call it revenue. So our sales is here. You don't need to leave a line basically. So we less from our sales, return inwards. So return inwards, or most times you can call it sales returns. Sales returns. So you less it. So let's say our sales is 500. Okay, let's say it's 800. Then our return is 10. So 800 minus 10, that gives you 790. So this is our turnover or net sales. Turnover or net sales. Then we less our cost of sales. Less cost of sales. So cost of sales, you have your opening. So here now, we are in trading accounts. So we are going to be dealing with the finished goods that their production has been completed. So opening stock of finished finished goods. Finished goods. So opening stock of finished goods. That's this. Then we have purchases. Purchases of finished goods. Purchases of finished goods. So these purchases of finished goods now, most times you will not be given, not even most times, you will not always be given the question. So what you are going to use is the market value. But if you did not determine the market value, if market value is not given in the question, it means you will not determine market value. So where you are going to stop is cost of production. So cost of production will be your purchases. If you are not to determine market value, or the question doesn't require that you determine market value. So cost of production will be your purchases. But now that we have determined the market value, so you bring your market value here as your purchases. Then most times in questions, you may be given additional finished goods or purchased. So when you have that, you put it here. So additional finished goods purchased. additional finished goods purchased. So you had it. Then when you had it, you have this. Then you call this costs of finished goods. I hope you can see my handwriting. So if that seems a little bit tiny or small, cost of finished goods available available for sale. You can see this one is for use. Why this one is for sale? Because it's finished goods. So finished goods are for sale, while raw materials are for use. So that's why we have use here. We have sale here. Then when we have this, then we less closing stock of finished finished goods. So closing stock we less it. Then we have cost of finished goods, cost of finished goods sold. Then this cost of finished goods sold, let's assume it's 300. Assumption, we are just assuming, because after we've solved one or two questions, you'll be able to have a deep understanding of all these that we've put on the board. So cost of finished goods sold, we have this. Then we want to get our gross profits. Gross profits. So cost of finished goods, how do you get your gross profits? On gross profit of finished goods. Gross profit of finished goods. So your turnover, we have adjusted our sales. So turnover minus cost of finished goods sold. That's 790 minus 300. That gives us that should be 490. So 490, yeah, 490. So we have that's we have that. Okay, so let's put this here. Let's put our cost of finished goods here. Okay, it's still the same basically. So let's put our cost of finished goods here, so that I'll be able to less it from our turnover. Then what we have is gross profits. Gross profits on finished goods. Gross profit on finished goods. So we have this. So that's gross profits. Then don't forget, we already made profit on manufacturing. So this profit on manufacturing here, we are going to add it to your gross profit, like I said. So we had it profits, because here now we are now moving to our profit and loss account. So this is where trading manufacturing account stops to get our gross profits. So our gross profit is 490. Now 790 minus 300. That gives us 490. I hope that is understood. Good. So profit on manufacturing. Profit on manufacturing. Don't forget we got that as 130. 130. Can I rub off this part so that I'll be able to complete the format? So I hope you all can see. Perhaps you want to, okay. So I want to rub off. So let me rub off this part. I need to manage the board. The board is very small. So just bear with me. You are going to be fine. So profit on manufacturing, that's what we have. Then if there is any other incomes, like let's say discounts received, we are going to add discount received. If there is any commission received, we add it. Commission received, we add it. If there is anything like rent received, we add it. So If there is any decrease in provision, it's also an income. You had it. And all other incomes, you had it. Then when you had it, you have this. So this is your total income. So income, total income, total income. These are total incomes. Then you have your so our total income is here. Let me bring this here. So total incomes, total incomes. Let's say that is 490 plus. Let's say 50, 50, 50. We are just assuming. So that's 200 plus 490. That should give you uh 690. So this is 690. So then since it is profit and loss account, we now want to get our net profit. And you know, net profit is gross profit plus other incomes. Gross profit, that's we have two profits now. That's gross profit on finished goods and gross profit on manufacturing. Then we add all other incomes. Then we have total incomes now. So we now less our expenses, all the expenses. So with respect to manufacturing preparation, as manufacturing concern, expenses may be classified into three. We can have administrative expenses, we can have selling and distribution, and finance charge. So those are the three classification of expenses you have. But most times, if you're in a hurry in an exam, you don't need to classify it. Just put all the expenses together and less it from your total incomes. Then you will get your net profits. So for the purpose of uh, clear understanding, let me classify those expenses. So expenses now, we are going to, so less expenses. So the first expenses that we have is administrative expenses. So under administrative expenses, we could have office expenses, office expenses. So we have that. So we could have office, office insurance, office insurance. We could have rent, rent and rates. So these are some of the administrative. We could have general expenses, general expenses. So these are some of the, but you could have other ones too. So this is, let's say this is this, less it. Then we have selling, this is another heading, selling expenses or selling and distribution expenses. So this is another heading. So under selling and distribution, you could have sales commission, sales commission paid and expenses. We could have bad debts. Bad debts. Bad debt is also under selling and distribution. You could have carriage outwards. It's also related to sales. Then you could have discounts allowed. Is also related to sales. You could have sales rep, sales, you could have salesmen salaries, and all that. You could have some other ones. So these are some of the ones we'll be writing for today. So when we solve question, we get to see other ones. Then the last heading now, we could have finance charge. So finance charge has to do with expenses that relates to the business has borrowed money and you need to pay back the money with interest. So the interest you pay on the loan you borrow as a business is classified under finance charge. So interest on loan. The interest on loan basically is the only expenses you have here. So you have interest on loan, then you transfer it here. transfer it. Then when you transfer it, so these are all the classifications, the headings of all the expenses in a manufacturing concern. So add all this. Let's say this is 20, this is 30, and this is 10. Then your net profit is gross profit plus other income. So this is the total income. Then you less all the expenses. So you are going to be having your net profit. You can also have net loss. Don't forget. That means if the total expenses here, this three, is greater than this, you are going to be having loss. But since this is greater than this three, then you are going to be having profit. So net profit. So what's our net profit? 690 minus, okay, let's say this is 40. So 40 plus 30, that's 70, plus 20, that's 90. So 690 minus 90, that gives you 600. So our net profit is 600 for the business in question. So I hope this is understood. So should you have a question regarding what we've talked about today, you can always tag it in, you can always tag the minutes of this particular area you do not understand. Then let's clear your doubts on that. So this is where we are going to be drawing the curtain for today. In our subsequent episode, we are going to be solving one or two questions to be able to illustrate all these formats and explanation we have talked about. So what more can I say? Continue to support us in any way you can. Subscribe to our YouTube if this is the first time you are watching our videos. To our regular students, continue to help share our videos to friends and relatives, and uh, click the notification bell so that each time we put out a video, you will get notified. And besides, you will be the first to get notified regarding that. So what more can I say? I will see you on my next video. Do have a good one. Bye bye.